It is always recommended to use earnings per share in conjunction with other pieces of financial information to gain a well-rounded view of a company's performance. While earnings per share tells you how much profit is allocated to each share, additional ratios, such as the price-to-earnings ratio, provide context by comparing the stock's market price to the earnings per share, which offers insights into market expectations and valuation. Similarly, comparing earnings per share with book value per share can either highlight or mask the effectiveness of a company's asset management. Analysts also consider ratios such as return on equity, which measures how efficiently a company uses its shareholders' funds to generate profit, and debt-to-equity ratios, which indicate the level of financial leverage the company is using. Together, these metrics help investors paint a fuller picture of the company's financial health by incorporating both profitability and risk. It is imperative to view earnings per share as a starting point to a company's quality or value. If one is trying to determine whether a stock is undervalued, earnings per share is typically integrated into the calculation of the price-to-earnings ratio, which compares the market price per share with the earnings per share. A low price-to-earnings ratio might suggest that the stock is undervalued relative to its earnings, while a high ratio might imply it is overvalued. However, the price-to-earnings ratio should also be assessed together with factors such as the company's growth prospects, industry position, and overall economic environment. Investors should keep in mind that earnings per share may not always correspond directly to the company's operational performance. It can sometimes be affected by extraordinary items, such as gains or losses from asset sales, restructuring costs, or one-time tax events. These items can distort the true recurring earning power of a business. Therefore, a prudent investor will often look at adjusted earnings per share figures that strip out these non-recurring factors to get a clearer picture of the company's core profitability. It is equally important to observe that earnings per share by itself does not give a sense of the overall risk profile of the company. Earnings per share must be viewed together with information about the company's debt levels, cash flow adequacy, and growth trends. Evaluating earnings per share alongside ratios that measure financial leverage, such as the debt-to-equity ratio, helps investors determine whether higher earnings per share come at the expense of taking on excess debt. Similarly, pairing earnings per share with free cash flow per share can illustrate whether the profits are translating into actual cash that the company can reinvest in its operations or return to its shareholders. Using these complementary measures allows investors to appreciate both the profitability and the sustainability of a company's earnings. Watch our other videos for more information on earnings per share.